Everything in this video is not intended as financial or investment advice and is for educational purposes only. I'm Josh Olszewicz, the head of research at Valkyrie, and let's take a look at the midweek market update. I'm going to start with the usual TradFi side of the house. First Republic Bank back in the news here because it appears to have had a not so great earnings report earlier this week. Stock down 30, 40, 50% today. I don't know, it was quite volatile. It was halted for volatility a few times. They're announcing, they're weighing, that they are potentially selling $100 billion in assets to address an asset liability mismatch. So this certainly doesn't help confidence for depositors, coupled with seeing, a stock chart like this, especially after today. Anyone who was still with FRC, may be experiencing additional concern with the headlines today. So it doesn't look like FRC is quite out of the woods just yet, and they may be getting closer to FDIC receivership at this point. If we look into their earnings, this is as of the end of March 2023. And if we compare, really the thing I look the most now relative to what happened with SVB and Silvergate and Signature is the uninsured deposits. And if we exclude the $30 billion that they were given by large U.S. banks, it looks like currently around 27% are uninsured. My guess is these will be made whole by FDIC should this bank go under. But it's obviously something to watch because the banking sector has had issues and continues to have issues as depositors flee for yield. And it's really that simple. If you can get 4.5%, 5% in a money market account, it's not going to sit in a savings account, your deposit, right? You're going to move your money with a click of a button because you can. And that's a big part of what's happening here. It's not really a problem. It's just a function of the financial system, right? And speaking of earnings, we're seeing more and more of this. This is Pepsi here from Joe Weisenthal highlighting revenue growth without any volume growth, which some are calling stagflation. Some are pointing to inflationary pressures there. Another one, Procter & Gamble, Joseph Wang pointing out 10% growth in price with a 3% revenue is what I assume this is relative to volume. So prices are definitely even still quite high. You could argue those inflationary pressures are definitely still there. Now, if we look at the meeting probabilities, it looks like a 25 basis point hike is a shoo-in for next week. It'll be interesting if FRC enters FDIC receivership into Friday evening, which is how they like to do things. Close it down Friday, open it up Monday, and then Powell, has to deal with that over the weekend and or into the meeting. My guess is they're going to raise 25 regardless of what happens, but that deposit savings differential will continue to get strained because you're strengthening the incentive to move your money out of your savings account and into a money market account. Probabilities also expecting a hold at that level with continued cuts, really sort of pricing in a recession by the looks of it. We'll see what happens when we get there. Probabilities have been quite wrong, we'll say most of the time over the past 6 months. Truflation coming down as well, regardless of what the earnings are showing for consumer goods. The truflation basket is down considerably. This is a year-over-year number, obviously, so prices are still, higher than they were years ago, but year-over-year it is down relative to their methodology and their basket. So this is good for CPI, it should be good for CPI, at least the metric, right, as the latest reported was at 5%. And speaking of recession, it looks like recessionary odds are quite high, the highest they've been since the 80s. And I don't bring any of this up to scare people. It's just this is what the data is showing, and it's worth knowing what the data is showing and being prepared for that. And on top of all this, the sort of soup du jour last week, the flavor of the week was commercial real estate. That's maybe taken a little bit of the back burner in the near term, but again highlighting the decline in cities across the U.S. And this is kind of blurry and fuzzy and hard to read, but we're talking about New York, Miami, Austin, San Francisco, the worst of it, measuring cell phone activity, which is sort of, an interesting alternative data point, definitely, but definitely also something to think about. It looks like Salt Lake City Bakersfield, Fresno, El Paso, seeing more sell phone activity than they were in the fall of 2019. So SF obviously at the lowest end here, just cratering if we're extrapolating this to people, to business, right, in that city. And talking about the DXY, which I have talked about probably every week now for the past 6 months, the legendary trader, Stanley Druckenmiller, is betting against the dollar. And I've seen increasing interesting TA chatter about reversals that I've talked about, on this channel when we're talking about the DXY, sorry. This could be any number of things: inverted cup and handle, head and shoulders. Any bearish chart pattern here on the DXY gets negated when DXY returns above 105. Now it could just range and range and range, much like the S&P has, and go nowhere. But the expectation here is definitely, at least from my seat, lower lows, not necessarily 90 to 95, but lower lows eventually. The S&P is kind of an inverse of that. S&P just holding this range really for a year now, being unable to break. And now this pattern, inverted head and shoulders, is expected to break up. It is expected to be a reversal, although it may not have a basis in reality. As long as it keeps making higher lows, the potential is there. Now, if we make a lower low, then that pattern is negated, right? And really the same thing with gold. All of these charts sort of sitting at a horizontal level, kind of waiting for probably the DXY to make a move one way or the other. DXY at what really is all-time highs, above 2,000, kind of being combative at that high over the past week. But the expectation here as well is higher highs. It's any number of things on technicals, a series of Adam Eves, Eve Adams, massive decade-long cup and handle, all sorts of stuff here. But the expectation based on technicals is higher highs for gold as well. Moving on to the crypto side of things, if we look at on-chain activity, we can look at active addresses and transaction counts. Similar, but not exactly the same as, daily active users or credit card swipes, things like that. Because each user can have multiple addresses, each user can be making hundreds of transactions, obviously. But we're still seeing transactions rise here. We're still seeing active addresses rise. We're still seeing activity in general rise. If we look at transaction counts specifically, and we zoom in here on the weekly, transaction counts are entering all-time high territory as far as relative to 2017, 2019. The interesting thing here is this is likely some sort of spam on the blockchain and or, I hate to say, non-organic transactions, but it is important to know what's going on here. In 2017, we had a bunch of spam on the chain. 2019, similar. So it wouldn't be out of the question that we sort of revisit those levels with spam on the chain here. Are these transactions paying for use of the chain? They certainly are, but they don't necessarily represent economic activity. And we can kind of see that if we look at just active addresses, because you're not getting as substantial rises in active addresses here relative to transactions as a percentage. So things look good, maybe not as rosy as reality there. And on ETH, we are also seeing a rise in price, but we're not seeing a rise in transactions. We're not seeing a rise in active addresses per se. So if you look at ETH's all-time highs here, usually it goes hand in hand with on-chain activity as expected. Usually bullish rallies in price go hand in hand with on-chain activity, continuous on-chain activity rises, sorry. So we're not quite seeing that just yet for ETH. So there is a bit of a divergence on that front. If we look at Bitcoin and Ethereum sitting on exchanges, it continues to decline, continues to dwindle, especially relative to 2020. And if we look at ETH sitting on exchanges versus sitting in the staking wallet or ETH being staked, we've actually seen for the first time that this level has crossed. So much like deposits are getting pulled out of banks and into money market accounts for better yield, you're seeing users pull ETH from exchanges into staking vehicles to gain that yield. If you're a long-time holder in ETH, if you're a believer in ETH, you're probably staking your ETH somewhere. And if you want to hedge it, if you want to trade it, you can do so through liquid staking derivatives, which is only a step removed from staking. So it's not exactly super complicated. And so long as there's no issues with staking, I expect this to just completely continue and sort of push activity maybe to the DEXs and outside of centralized exchanges. If you look at ETH staking withdrawals, they just completed a protocol change a couple weeks ago on the 15th. And we still have ETH sitting in the exit hopper in the exit queue, waiting to come out around 630,000. Most of that has been from Kraken as far as ETH withdrawn all the time, because Kraken is mandated by the SEC to withdraw all of that ETH. Now, that doesn't mean that all of that ETH is being sold. In most cases, it's just being moved to another venue. But I think until all of the big exits are done, ETH price just may continue to struggle. We don't really know for sure how much is being sold versus moved. We can tell that around 600,000 net has been removed from the staking environment since the 15th of April, but it's hard to tell exactly where that goes from there. You can definitely track it down, but it's certainly not going to centralized exchanges based on the metrics I just talked about. And then looking at stablecoins, continuing to see Tether grow and grow and grow, USDC shrink and shrink and shrink. BUSD will never grow again. That can only get smaller. So this is a users voting with their feet phenomenon. It's really better for the industry if we have competing stablecoins. It's better for the industry if we have stablecoins based in the US and not offshore, which is what Tether is. But until there's regulatory clarity, until there's clarity on reserves and where they're held and in which bank, I don't expect USDC to suddenly pop up here anytime soon. And on top of that, just today, this morning, they emailed everybody saying, they being USDC and Coinbase, saying, hey, hold your USDC on Coinbase for a yield of 3-point-something%. And mere moments ago, from Nick Timmerhouse of the Wall Street Journal, highlighting that the Fed updated its eligibility rules for reverse repo. USDC, along with Paxos, had been using reverse repo, Paxos to a greater degree. But basically the statement is saying, look, if you're not a bank, effectively, sorry, you can't use our facilities. And ultimately, the Fed can be the decider here if you get to use reverse repo, in the sole judgment of the New York Fed. So if they wanted to, they could go one by one and say, sorry, stablecoins, you're no longer allowed. And then this was, from November, Nick, again, sort of highlighting that Circle specifically moved their reserves to a new fund for this exact purpose. And it's a shame because stablecoins like Circle are massive buyers of US Treasuries and effectively Johnny Appleseeding their strength of the US dollar around the world. So continuing to hurt USDC in this manner definitely doesn't help the US dollar's cause globally. Moving on to some technicals here, we've got a long-term zoomed out view. I always like to start here. It's a good grounding for general bullish and bearish expectations, at least for myself. Are we overbought? Are we oversold? How do we look relative to history? This is the power law corridor, as it's known, and the 200-week moving average. Yellow bars here represent the halving periods when the block reward drops by half. The next halving is somewhere in April, probably, or early May. And based on where we sit relative to halving, based on where we sit relative to power law corridor, it looks like even despite the massive drawdown we had, 78%, 80% from all-time highs, we're still on track for a similar potential 4-year cycle. Lots of asterisks included in that, but our path to a bullish run looks intact to me still. And if we look at more nearer term technicals, here again is a 200-week moving average. We've got yearly pivots on here. We've got a series of chart patterns, again, the inverted head and shoulders, along with this megaphone we had. And what was interesting is we sort of hit the bottom edge of the zones of the expected targets when you take the range and project it higher, the depth of these patterns projected higher from the breakout point, and just immediately reversed off of that in a very, very strong way. So returning to the 200-week moving average wouldn't be out of the question. Returning to the inverted head and shoulders neckline, not out of the question. Retesting the yearly pivot. All those things are on the table as far as this confluence zone of support. And if it does occur that we move lower in the near term over the next 2 weeks, let's say, it may shape up to something like this, where we're still held within this resistance diag of the previous megaphone, and we're sort of painting this head and shoulders chart pattern. We don't usually paint pattern after pattern after pattern. It just so happens that we have been. So having some idea of general chart pattern rules is certainly helpful, or been helpful, over the past 6 months in crypto land. And if we just look on trend metrics, this is the cloud. And if we look at the mean reversion level, the mean reversion level is around 25,000. So again, it's not out of the question. Typically in any trend, we mean revert over and over and over again, and then make a decision. You know, just like August 2022, we mean reverted, made a decision, mean reverted, made a decision, FTX failed, right? And we just attempted over and over and over until we actually had the momentum and the stamina to overcome that resistance. So we could still mean revert in the near term to that level. On ETH, kind of zooming out again, this is a 3-day chart. Since 2019, it's still holding a decent uptrend. You know, it's at the bottom of this pitchfork here. It really doesn't look all that bad from a overbought, oversold conditions relative to this period. So as much as it's struggling and has been struggling, you know, it could continue to struggle at this level for quite some time and still hold an intact trend here. Zooming a little bit on the daily, if we look at, you know, where we've been over the past year, been held within this range, briefly popped above that range, back into the range now. So it's been quite a choppy mess. And despite ETH successfully transitioning from proof of work to proof of stake and moving into this staked environment where things are unlocked, you wouldn't really know it, you know, based on price. Just looking at price, you'd have very little idea that there's any success there. Now, have we kind of 2x from the bottom? Sure. But there has not been, you know, any arguably, you know, sustained momentum here on ETH. And ETH on the daily cloud approaching its mean reversion level around 1800, 1750 there. Ultimately for ETH, you may need to wait for a move through the weekly cloud. Now this is a 1 of 1 for ETH on the weekly here. You can see where it moved through the cloud in 2020 and off away it went in 2021. Now Bitcoin has had several of these moves through the cloud like that. So on technicals for ETH could continue to struggle until it's back above the cloud. That's all for this one. This video is for informational purposes only, and the opinions expressed are not financial or investment advice. All opinions are my own and do not reflect the opinions of Valkyrie Investments and its affiliates. No fiduciary obligation or duty exists or is created between you and Valkyrie Investments or its affiliates, including me, by virtue of any opinions expressed in this video.